Thank you very much, Mr. Chairman. I'd like to thank the co-chairs of the commission, and I take to heart the recommendation that Mr. Thomas is making about Samuelson and what he's explaining about Samuelson, Billings, and Victors. There's a fundamental debate that's going on in the Congress of the United States today. This fundamental debate is about regulation. On this side of the aisle, we believe that we understand and recognize the cause of the meltdown and what brought us to the brink of a depression. And we have also heard from our regulators who are agreeing that they need to be supported, they need more funds, they can do a better job, and the Dodd-Frank bill helps to do that. On the opposite side of the aisle, we are hearing we need less regulation. My colleagues on the opposite side of the aisle are claiming that regulation is a job killer. And so this debate is so important because it's about which way America. Are we going to have regulatory agencies that turn a blind eye, that are not supported with their technological capability, are going to be intimidated? Or are we going to have a regulatory system that's going to do the job that they're expected to do, not only to protect the public and the consumers, but to help regulate what happens in this economy? And that's what it's all about. Now, Mr. Angelides, you said in your statement that the crisis was a result of human action, inaction, misjudgment, not Mother Nature. Financial executives and the public stewards of our financial system ignored warnings and failed to question, understand, and manage evolving risk within a system so essential to the well-being of the American public. Second, we found widespread failures in financial regulation that proved devastating to the stability of the nation's financial markets, and on and on and on. And basically, that's the conclusion that some of us have come to. In your discussion, did you find that there was indeed a consensus about what you have just identified here in some shape, form, or fashion about the failure of our regulatory agencies to do its job?
Well, let me just say that certainly speaking for the commission's conclusions, we really found there was first of all, that we believe this was avoidable. There were plenty of warning signs along the way. You don't create $13 trillion worth of mortgage securities and have no one notice. You don't have the FBI warn about rampant mortgage fraud in 2004 and 2005 and have no one notice. You don't have unprecedented escalation, I guess Mr. Royce talked about, in terms of asset bubbles and housing prices. And there were plenty of warnings, for example, at the Federal Reserve about egregious and predatory lending practices. Mr. Greenspan said regulation was not the answer. The answer was law enforcement, but from 2000 to 2006, the Federal Reserve made only 3 referrals to the Department of Justice. But there was a twin phenomenon here. There was a breakdown in regulation, and we detailed that. And I might add, I don't want to speak for my other members, but I think there was an acknowledgement. We may differ on the cause, but the SEC had the ability to curb excesses at the investment banks. They did not. The Federal Reserve Bank of New York had chances to curb the excesses at Citigroup. They did not. The Office of Thrift Supervision, which oversaw AIG, didn't even understand that its mandate, and it had signed a directive with the European Union to oversee the whole company. So there were dramatic breakdowns, but they were also accompanied by dramatic corporate governance and risk management breakdowns at companies. At Citigroup, this was an organization that did not know that it had $55 billion worth of exposure to subprime mortgages. They represented to the public all through 2007 that they had $13 billion. They had about $25 billion in what are called liquidity puts off balance sheet. The executives themselves did not learn until the fall. and they represented still to the public that they had $13 billion at the same day that their board was being told our exposure is $55 billion. At AIG, they wrote $79 billion of credit default swaps, protection on subprime securities. Neither the CEO, Mr. Sullivan, the CFO, Mr. Bensinger, the chief risk officer, none of them knew that there would be collateral calls made on AIG if the market value of those securities fell. So when Goldman Sachs makes their first collateral call in July of 2007, they're shocked. And of course, as everyone knows, what happens after that, the collateral calls accelerate, ultimately leading to the collapse and the taxpayer bailout. So it was a twin phenomenon of deregulation, gaps in regulation, failures of regulators to use the powers they had. And I want to be clear to all members here of both parties. There were a lot of powers that went unused. I believe Dodd-Frank has helped close a lot of the gaps that existed. But the fact is there was a twin phenomenon here where there were clear breakdowns in corporate governance and management.
Thank you.
Thank you very much. I yield back the balance of my time.